Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 8th, and today's theme is simple. Rates, oil, and AI chips are all the same story, pricing risk.
I love when the market has one storyline because my brain can only hold 3 tabs open, and 2 of them are snacks.
We'll do 3 moves. First, the Fed cut chatter. One governor talking about 1.5 percentage points of cuts in 2026. Second, oil reacting to Venezuela supply headlines. Third, the AI chip policy maze. Nvidia's H200 in China, plus China investigating Meta's AI acquisition.
Your mortgage, your gas tank, and your robot overlords. Perfect. Let's ruin everyone's calm in under 6 minutes.
Story 1. A Fed governor, Stephen Moran, said he's looking for about 150 basis points of rate cuts in 2026 to support the labor market. He also said underlying inflation is running around 2.3%, which he framed as basically within the noise of the Fed's target.
When a central banker says within the noise, that's like your doctor saying, it's probably fine, while slowly backing out of the room.
Here's the simple version. Think of interest rates like the thermostat for the economy. Higher rates cool spending and borrowing. Lower rates warm things up, especially housing, autos, and business investment. Moran is basically saying, inflation is close enough, so let's prioritize jobs.
So the Fed's looking at the economy like, she's shivering, give her a blanket. And the blanket is cheaper money. But blankets also make you sweat, and that's inflation.
Exactly. And the political overlay is loud today, too. Treasury Secretary Bessent said more Fed cuts are the only ingredient missing for a stronger economy. That's not the Fed speaking, but markets still hear it as pressure for easier financial conditions.
Only ingredient missing is such a cooking show line. Like, today we're making a souffle, and the only ingredient missing is turning down interest rates by a lot.
Why this matters to normal people? Rate expectations hit borrowing costs before the Fed even moves. If investors believe cuts are coming, longer-term yields can drift down, which can help mortgage rates, car loans, and refinancing math. But if inflation reaccelerates, those gains can reverse fast.
Actionable takeaway. If you've got floating rate debt, you're basically dating the Fed. It's complicated, and you should know when the next "we need to talk" meeting is.
Oil moved higher as traders assessed the Venezuelan supply outlook. Headline risk is back in the barrel market. Even when prices move higher modestly, it's the uncertainty premium that matters. Refineries, shippers, and airlines start paying for volatility.
Oil traders love a good plot twist. It's like reality TV, but with pipelines. Someone yells supply disruption, and everybody flips a table.
Finance behind it, in plain English. Oil is globally priced, but it's locally felt. If the market thinks fewer Venezuelan barrels will flow, or that access will be politically constrained, prices can rise even before physical supply changes. It's like concert tickets. Rumors of fewer seats raise resale prices immediately.
So we're paying rumor tax at the pump. Great. My car doesn't even run on rumors. It runs on regret and premium unleaded.
Why it matters. Energy feeds inflation directly through gasoline and indirectly through shipping and manufacturing. If oil stays jumpy, it can complicate the Fed's "we can cut a lot" narrative because inflation expectations can firm up even if core measures look calm.
So the Fed wants to hand out blankets, but oil is over here lighting the couch on fire. That's the vibe.
Story 3. A China semiconductor expert urged vigilance for mainland firms buying Nvidia's H200 AI chips, saying it's a puzzle why the U.S. would allow such advanced chips to be available, given the back and forth on restrictions. In parallel, China is investigating Meta's latest AI acquisition of Manus for compliance with export and investment rules.
Nothing says healthy market like buying a chip and wondering if it's a gift, a trap, or a diplomatic group project.
The finance angle. Chips are now a strategic input, like oil used to be. If rules change, supply chains reprice instantly. Revenues, margins, and capex plans. For investors, this shows up as higher policy risk, which can hit tech multiples even when earnings look fine.
So the PE ratio is basically asking, how likely is it that a regulator wakes up and chooses chaos?
And for normal people, it's not abstract. AI compute affects product costs and features, everything from customer service automation to how fast new tools ship. If cross-border chip access tightens, you can see slower rollout, higher cloud costs, and more regional walled gardens in apps and services.
Actionable takeaway. If your job touches tech, marketing, design, finance, whatever, build skills that travel. Tools change, policies change, but being able to measure ROI and communicate clearly is export control proof.
Quick recap. The Fed cut conversation is getting specific. 1.5 points in 2026 was floated, while the Treasury is openly cheering for lower rates. Oil is reacting to Venezuela supply uncertainty, which can feed inflation expectations. And AI chips, plus M&A, are increasingly governed by policy, not just price.
So your 2026 bingo card is rate cuts, energy chaos, and regulators doing surprise drop-ins, like they're checking if your AI model is doing its homework.
If you want one practical move today, write down your biggest sensitivity, rates, energy, or tech, and hedge it with behavior. Recheck your debt rates, tighten a fuel budget line item, and diversify skills and income streams where you can.
And subscribe so you don't have to doom scroll your way into a bad trade and a worse mood. We'll keep it structured, he'll keep it calm, I'll keep it honest.
That's it for BD Daily Finance News Podcast. Like, subscribe, and share this with someone who thinks basis points is a new sneaker drop. See you next episode.